Okay, let's unpack this. We've been looking through this fascinating stack of articles and research you shared on multiple income streams. And one thing really jumps out.
What's that?
The average millionaire, according to several of these sources, often has like 7 or even more income sources.
Right. It's common finding.
And it's not just about getting rich, is it?
Yeah.
The sources kept emphasizing it's really about, peace of mind.
Exactly. And not putting all your financial eggs in one basket, as the old saying goes.
Precisely. So today we're doing a deep dive into this whole world of multiple income streams, looking at it not just as a financial strategy, but maybe more like a pathway, a way to accelerate your financial goals and, well, build more stability.
Yeah. And what's fascinating here, reading through the material, is how it frames multiple streams as really an essential part of wealth building. It's not just a nice to have.
Right. It's fundamental to achieving your financial goals, whatever they might be for you.
It's about building a kind of diverse financial ecosystem around yourself.
Absolutely. So our mission today, based on these sources you sent over, is to break down the key ways to actually create these streams. Give some concrete examples, maybe some surprising ones, and lay out a bit of a roadmap how you can get started without feeling, totally overwhelmed by it all.
And we'll stick closely to the research provided.
Definitely. So at its core, why do multiple income streams matter so much? Your notes really hammered this home. It boils down to peace of mind, right? Financial stability.
Yeah, fundamentally, it's about reducing your reliance on just one paycheck or one source of money.
So if one stream slows down or dries up,
You've got others to cushion the blow.
Exactly.
It builds resilience.
If we zoom out a bit, it's really about that long-term wealth building, creating what did one source call it? A well-diversified wealth portfolio for your future self.
That's it. And the stability, the resilience it gives you, it's invaluable. One article described it as a financial shock absorber.
I like that. Okay, so we get the why. Peace of mind, stability, shock absorption. Now, the big question, and some of your articles posed it this way, how do we actually build this?
Right, the practical steps.
The consensus from the material seems to point to 3 main ways, 3 sort of pillars: active income, passive income, and portfolio income.
The big 3.
Yeah, but before we dive into each one, let's set expectations. All of these, they take time to get going, don't they?
Oh, absolutely. That's a constant theme in the research.
It's not an overnight thing. And the sources also talk about diversifying the streams themselves, kind of like you diversify investments.
That's a crucial point. Each one needs that initial time and effort, patience, a structured approach. The articles really stress that. It's like planting seeds, not harvesting the next day.
Got it. Okay, let's kick off with the one most people know. Active income.
Right.
This is basically income where you trade your time or your skills directly for money, yeah? You work, you get paid.
The classic model. Your main job, usually.
Exactly. Your regular paycheck, commissions, bonuses, tips. Those are the obvious examples. But the sources you shared mentioned other ways to boost this.
Like what?
Well, obviously getting a better paying job or maybe a part-time gig if you have the time, but also starting a side hustle or even a small business.
Okay.
One article had a neat example, a graphic designer offering quick brand audits. High value, didn't take tons of time per client, but really boosted their active income.
Smart. Focusing on a specific need.
Yeah. And another simple one they mentioned, often overlooked, just selling stuff you don't need anymore. Decluttering can actually bring in some cash.
That's true. Sort of found money.
So why start here with active income?
Well, this raises an important point the sources kept making. Active income usually has the lowest barrier to entry. It's often the easiest way to get started building multiple streams.
Ah, okay. So it's foundational.
Totally foundational. It provides the initial money, the momentum you might need for the other types. It's kind of the engine that can power everything else.
Right. Okay. So you've got that active income engine running. What's the next layer people often look at, especially if they want something that doesn't require constant hands-on effort?
That leads us straight into passive income, which has a certain allure, doesn't it?
It really does. But there's a catch, right? The articles were quite clear on this.
Oh, yeah. The biggest misconception is that it's set it and forget it. It's really not.
So while these streams might not need your active daily work once they're up and running,
Right. The asset is doing the work.
they need serious active effort up front to create them.
Absolutely. Significant groundwork. And even then, there's often ongoing maintenance, maybe occasional check-ins or updates. Think of it less as passive and more like Leveraged income, maybe.
Leveraged income, I like that. Okay, so let's get concrete. What are some common examples the sources brought up? And maybe where do people stumble?
Well, a big one is adding a passive element to an existing business or skill set, like creating an online course, an ebook, maybe an app, something you build once and can sell repeatedly with minimal extra effort per sale.
Okay, that makes sense.
Then there's affiliate marketing. You recommend products or services you like using special links and earn a commission if people buy through your link.
You see that a lot on social media, blogs.
Exactly. Done right, it can earn money passively. Real estate is the classic example, of course. Rental properties.
Where the rent covers your mortgage, expenses, and hopefully gives you profit.
Right. Or even things like investing in self-storage units, which one source mentioned. And then there's peer-to-peer lending, P2P.
Yeah, I've heard of that. Lending money to others through online platforms.
That's the one. You earn interest on the loans, but, and this is a big but highlighted in the research,
Uh-oh, what's the catch?
it can be very high risk. Very high risk. Unlike putting money in a savings account, these loans often aren't secured. If the borrower defaults.
You could lose your money.
Exactly. So you absolutely definitely want to do your research on the platforms, on the borrowers, understand the risks involved before jumping into P2P. It's not for the faint of heart or the uninformed.
Good warning. Okay, so active, then passive. What's the third pillar?
Portfolio income.
Portfolio income. Okay, break that down.
This is the money you earn from your investments. Think stocks, bonds, funds, stuff in the financial markets mostly.
Gotcha. So specific examples would be?
Well, profits. When you sell stocks for more than you paid capital gains.
Right.
Interest income, say, from bonds or even high-yield savings, though that's usually smaller. But the great thing about interest, as one of the primers you shared pointed out, is compounding.
Ah, yes. Einstein's eighth wonder of the world.
Pretty much. Your earnings start earning their own money. It snowballs over time. And then dividends.
Dividends.
Yeah, that's what companies you own stock in pay out a portion of their profits directly to shareholders, usually quarterly.
Okay, so how do you actually increase this type of income?
Well, by investing more, obviously. But strategically, it means putting money into company stocks, into bonds.
Which are like loans to governments or companies?
Exactly. And investing in various stock market funds, things like index funds or ETFs, exchange-traded funds.
Those are like baskets of stocks, right? So they're diversified.
Precisely. They spread your risk. Now, if we connect this back,
Go on.
that active income we talked about,
Yeah.
it's absolutely crucial for building this portfolio income. You need money to invest, right?
Makes sense. You need the seed money.
Exactly. And leveraging things like employer-sponsored retirement accounts, a 401k or 403b, especially if there's an employer match.
Free money.
Basically, yeah.
Yeah.
Or opening your own IRA, an individual retirement account. Consistently putting money from your active income into these accounts lets it grow, often tax-advantaged,
Yeah.
and really lets that compounding, those dividends, that interest, work magic over the long term.
It's about putting your money to work for you.
That's the essence of portfolio income.
Okay. Active, passive portfolio. That's a lot to take in. So what does this all mean for, someone listening? How do you actually get started without getting paralyzed? What were the practical steps in the materials?
Step 1, and this came up again and again, start small.
Don't try to do everything at once.
Exactly. Pick one thing.
Right.
Pace yourself. Build up gradually. Trying to launch 5 streams simultaneously is a recipe for burnout, according to the sources.
Okay, start small. What's step 2?
Start with active income first.
Back to the foundation.
Yep. It's usually the lowest barrier, the easiest way to get some extra cash flowing. That extra cash then becomes the resource, the capital. You need to build the passive and portfolio streams later. Build the blocks in order.
Got it. Active first, then what?
Step 3, patience and consistency.
The hard part.
Often, yeah, things take time. One article would put it nicely, all good things take time. Don't get discouraged if you don't see huge results immediately, especially with investing, where compounding needs time to work. Just stay consistent. Keep at it.
Start small, start active, stay consistent. Sounds simple, but probably hard in practice.
It requires discipline. But there's one more point, maybe the most critical point that echoed through every single piece of research you share.
Okay, what is it?
Do your research.
Sounds crucial.
Absolutely essential.
Yeah.
For any stream you pursue, active, passive, portfolio, you need to understand how it works. What are the real costs? What are the risks?
So not just jumping into things.
Definitely not. Research companies if you're job hunting. Research your market if you're starting a business or side hustle. Research the platform and the investment if you're considering passive income like P2P lending or real estate. Research stocks, bonds, funds before putting your money in.
So research applies everywhere.
Everywhere. That understanding, that knowledge, is what builds genuine financial stability and peace of mind. It's your best defense against costly mistakes. It is so, so key.
Right. Knowledge is power, especially financial power.
Hmm.
Okay, so just to wrap up then, multiple income streams, it's really about building that financial stability.
Cultivating peace of mind.
And ultimately, building real long-term wealth for your future self. The research makes a strong case.
It really does. And maybe a final thought to leave people with, drawing from the sources. The path to that well-diversified wealth portfolio isn't just about grabbing different assets.
Okay.
It's about continuously learning, adapting your understanding of how money can really work for you, using your effort wisely, using your investments smartly.
So the challenge for you listening is, maybe think about which one stream, just one, you could start researching today.
Exactly. Take that first small step.